Hey everybody, it's Phil Sterzullo from Select Software Reviews, back with Whiteboard Wednesdays. And today we're going to talk about how to analyze our vendors' financial health. This is not a 101 video. This is really for people who are looking for more of an advanced level understanding of their vendors. This is also going to be helpful if you're trying to interpret these big headlines about acquisitions like, XYZ company got bought for $100 million or $1 billion or whatever, and trying to figure out, is that a good outcome? Is that a bad outcome? How do I understand whether or not my vendor is doing well from a financial perspective or other companies in my space actually? So this is gonna get really finance nerd heavy. If you have questions, shoot me an email, find me on LinkedIn. But I hope that this is a useful framework and useful context for understanding the vendor ecosystem in a more in-depth way, especially for those folks who are really trying to be masters at this discipline. Okay, so here's a pretty simple framework that I find very powerful to understand at a high level what is the financial health of a vendor. On the y-axis, we've got revenues, and on the x-axis, we've got employees. So, and this is, by the way, the employee count of the HR tech vendor. So let's say that this vendor has 100 employees. Most companies, we can assume, run at break even. So if you've got 100 employees, maybe they make 150K each all in. It also includes some stuff like office space, maybe some tech, etc. That's about a $15 million a year cost basis that you have to cover with your revenues to be a break even business. So we can guesstimate that this company is doing about 15 million bucks a year in revenue. And this relationship holds whether you're a 10-person company or a 1,000-person company. There's basically a 1-to-1 ratio here using this trick. Okay, great. So we know that this vendor has about 15 million in run rate. If the company is not profitable, meaning if it's venture backed, they're probably going to have actually less revenues, because we can assume that their profit margin is somewhere down here below the x-axis. They're losing money, therefore they're raising venture capital money, and they're losing money because they don't have enough money to cover their costs. Flip side of that, bootstrap companies, most private equity backed companies, founder-owned companies, family-owned companies, publicly traded companies, they need to make a profit. Nobody's giving them money to spend to fund their losses, and therefore we can assume that their revenue is higher. Maybe this company actually has closer to $20 million in revenue, whereas maybe this one's more like $12 million of revenue. So this is a really useful framework for understanding approximately how much revenue somebody has. Of course, when we look at LinkedIn, we can understand where the employee count is growing. If you don't have LinkedIn Premium, you can look at the career site, how many recs they have open, multiply it by 4. That's more or less how many people they're gonna hire in a given year. And you look at that relative to their employee count, a little bit of churn, understand, is this number going up? And maybe they're growing really fast. Is it trending down? This is really useful to understand maybe where this number is and where it's going. And it's a really good indicator for the product market fit of the business, the retention of customers. This number, revenue, is not a perfect indicator, and revenue growth is not a perfect indicator of whether or not it's a good company to partner with, but it's a really, really good criteria to have when you're thinking about partnering with a vendor. And in fact, on Select Software, we almost never put companies on our site that have revenue below $1 million because product market fit really isn't there, customer success isn't there, etc. They can't handle customers that well yet. And it also says a lot about the health of the organization. Same thing if a company is trending downwards, that's usually a good sign that we're going to take them off the site. Okay, so now this is where it gets even more finance heavy. We're going to talk about these splashy valuations that you see when people raise money, people sell the business, what's good, what's bad. We've all been on a call with a sales rep where they're like, we've raised $150 million from the best VCs ever, blah, blah, blah. And sometimes that's an amazing thing, and sometimes that's a really bad thing. And we're gonna look at why. So let's say that we've got a vendor that's raised $100 million from really amazing venture capitalists. And this $100 million gives those VCs, let's call it a 60% stake in the business. So the enterprise value, and this is how much the business is worth, that's the valuation. Let's say that the enterprise value is $50 million. Well, everybody knows if you raise 100 and your company's worth 50, you're not in a great shape, right? So what happens in this scenario is that the VCs, they have 60%, but the way that their stock work, it's called preferred stock, they have the right to either get their money back, or as much as possible with the amount of the business, or get their 60%. So in this case, if they take as much to get their money back, it's 50 million bucks, or they can get 60%, which is 30 million. So of course, they're gonna get their money back. And so the common equity, which is how much the CEO's stock's worth, the employee stock, everybody that works there, it's worth $0 because 50 minus 50 is 0. So in a company like this, everybody's jumping ship. If you're a good salesperson, product manager, engineer, executive, you are leaving this company. You are jumping off. And so if I see a company that maybe their revenue, maybe their employee count is 100, but it's trending downwards, I say, geez, okay, maybe this company is like a 10 million revenue company, but what's it actually worth? Maybe it's only worth 3 or 4 times revenues because it's trending downwards. So if it's worth 3 or 4 times revenues, 10 million, so it's worth 30 million bucks, but they've raised 100. I know the common equity is worth 0, and therefore I'm pretty sure I don't want to partner with this company. Let's look at a couple other scenarios here. And by the way, pro tip, shortcut, the best companies out there, their ratio of raise to enterprise value, it's going to be a 1-to-6 ratio. So you're gonna see a company that has $1 billion valuation and has raised $160 million. Good companies, 3-to-1 ratio, bad is 1-to-1. If you get a 1-to-1 ratio, you're in trouble. Let's see why. So let's say this company that's raised 100 million bucks, they actually have $100 million of enterprise value. Again, the VCs, they can either get their money back or they convert into the common equity and get 60. Of course, they're gonna get their money back. And in this case, 100 minus 100, common's worth 0. Okay, let's say this company is worth $200 million. So in the $200 million scenario, the VCs can either get 100 back or they get 60% of 200 million, which is 120 million. So they're gonna do that. And 200 minus 120 is 80. Not great. You know, like this 60% is a huge, it's barely over what we call the preference stack, which is how much preferred stock the company owes. But the common is worth something now. And so we're starting to get close to this 3-to-1 ratio. And therefore we know that they can attract top talent, they can retain top talent. And you can kind of think about this all the way down. Let's pretend this is a $1 billion company. And so the VCs can either get their money back on an exit or they can get 60% of $1 billion. They're gonna do this. And look, they made a 6X, they're really happy, you know, on a really big amount of money. There's 400 million bucks left for the common. Everybody's really happy in this company. It's growing fast. It's able to hire top talent. And it got to this level because they have a really high revenue and it's growing really quickly. So when we see these ratios in the right way, that's a really good sign for us that things are working here, because these VCs, they're smart people. That's why they control large sums of money. This is useful for understanding when you get on the call with a sales rep and they're like, we've raised $100 million. It's like, all right, well, what's your valuation? 50. Okay. So what are you looking for, a new job because your stock options were 0? Oh, it was $1 billion. Okay, that kind of makes sense. This is also useful. It's useful for buying HR tech. It's also useful for understanding these acquisitions. So this chart, enterprise value, aka how much the company's worth relative to payout, total payout, it's a 1-to-1 ratio. $100 million enterprise value means there's $100 million of proceeds. And then what we look at is, okay, if this thing's 50, it's all going to preferred stock, right? Until the thing hits 60 million, it's all going to the preferred stock. and then there's a time when they just convert, or they just take their 100 million bucks back or whatever, and then eventually the common is worth a bunch. And we want to partner with companies that are in this side of the scenario, because that is when the common equity is worth a lot. The VCs are happy because they're making a multiple instead of just getting their money back. The salespeople are happy, the product managers, the engineers, and they're happy because the customers are happy. And the customers' happiness shows up in the revenue amount and growth, which shows up in the enterprise value, which then dictates how much the stock is worth, preferred versus common. So I promised a finance heavy, non-101 understanding of your vendor's financial health. I hope this is an interesting topic. It is for me, and I also am aware that I'm a bit of a finance nerd. If this is confusing, take a look at the write-up. Hopefully that'll illuminate things a little bit more. And if you have questions, find me on LinkedIn, shoot me an email. I'm more than happy to go over this stuff. If there are tangents off this that you want to explore, let me know. Maybe another future Whiteboard Wednesday video, maybe an interview, etc. Thanks a lot for checking out our videos. Phil Strazula from Select Software Reviews.